at Washington Crossing Advisors, what we've done over the years is follow a thing that we call our barometer, which it takes a lot to get into it, but it's about 30 different indicators amalgamated into one number. And that number jumped the most substantially it has in years in the first quarter of this year. And it makes sense. If you have easing financial conditions, central banks that are becoming more supportive, you're now seeing a big pop in manufacturing activity and GDP expectations around the world, especially out of the United States and China. We need to cop to that and follow those facts. As far as Europe is concerned, we agree that there's cheaper valuations to be had there, but there's a real significant prospect for recession on the continent, and we're staying a little bit further away from that. So we're still sticking with our U.S. domestic focus as Europe continues to work its way through its problems.
Tony, speaking of U.S. domestic, looking at the holdings in the Oakmark Select Fund, which I know you oversee, I mean, despite Alphabet being roughly 10% of your net assets, at least as of the end of March, you seem to really like financials at 25%. Why?
Well, we like financials because they have a great combination of good fundamentals and low prices. They're growing their pre-tax profits mid to high single digits today, and they're returning high single-digit percentages of their earnings to shareholders via buybacks and dividends. And we think that's a great combination. They're earning mid-teens returns on tangible equity, and companies that are growing, earning mid-teens returns should be selling closer to 2 times tangible book, not 1.
2 times tangible book. When was the last time we saw that?
We do typically see that near the end of the cycle, but that's where fair value should be for a bank earning mid-teens returns on tangible equity.
Kevin, what's your favorite sector?
Well, we like the consumer. We think that the consumer has been and will continue to be an engine of stability for the global economy. Consumer discretionary, consumer staples, both of them we think offer some good value here. So we would focus there. And I'd also point out that some of the healthcare damage that has been sustained in the last month is worth taking another look at. So, yes, we're going into a political period. Healthcare is going to have a lot of headline risk, but we think there's some good balance sheets and some good valuations to be had in that sector as well.